Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks fell Wednesday as Wall Street digests mixed messaging from Fed officials on interest rates. Meanwhile, markets also eyeing a stalemate on Capitol Hill. Going to be digging into all those stories right now. There's just an hour to go until the closing bell on stocks. They are lower. Let's just take a look at the major averages here. The Dow is lower by about 150 points. The S&P 500 down about 0.3%. The NASDAQ also down about 0.3%. Let's welcome in here our Washington correspondent. That would be Ben Worschel, and our data and markets editor, Jared Blickery, joining us to break down all the headlines. Jared, my friend, let's start with you on the trading action so far today.
Thank you, Josh. We got a second day of losses here, but they're not big. As you just said, the three majors down by about 0.3%. Here's the Dow, and let's take a look at the intraday price action. Started out just slightly in the green, drifted into the red, and we've just been camping out by these lows basically since the lunch hour. And you take a look at the NASDAQ, not too much of a different story, though, although a little bit more off of those lows, and the S&P 500, very similar chart. I do want to highlight the small caps. Russell 2000, which reached a record high for the first time in years last week, has been stumbling a little bit. It is down 0.7%, so kind of leading the way down here. And let's take a look at the bond market. We've seen yields just a little bit up today, 2 basis points for the 30-year to 4.76%, 10-year at 4.15%, had been close to 4.0%, so it's risen a bit since that Fed meeting and presser with Jay Powell last week. And here's the U.S. dollar index, up about 65 basis points or 65 basis points or 0.6%. That's actually quite a bit for the U.S. dollar index. That also has been rallying off the lows last week. But you put it in perspective, still down 10% and really a whole lot of nothing here over the last month or so. Let us now take a look at the sector action. Energy leading the way higher, up 1.4%. Crude oil, by the way, is up. I think it's having the best 2 days since the end of July. So that's the strength that we're seeing in the energy market. After that, we got utilities and then two retail sectors. We got consumer discretionary and consumer staples. Those round out the four green sectors. All of those outperforming the S&P 500. To the downside, we got materials, XLB leading. That is down 1.3%, followed by real estate, communication services, and tech. And speaking of tech, let's take a look at the NASDAQ 100. Tesla's a standout here. It's up 3.5%. Nice to see there, up about 10% on the year after turning positive finally a week or two ago. And then kind of a mixed picture for the mega caps. Broadcom and Meta, Microsoft in the green for a little bit, but Nvidia down about 0.75%. Alphabet off 1.5%. And I like to take a look at the leaders, kind of a sentiment look here. We got cannabis, solar, oil stocks, China, and Bitcoin kind of leading the way. Also biotech and retail doing well. And I'm going to close on China because I want to show you some green here. We got Alibaba, nice 8% surge. That stock has really come alive recently. Pinduoduo up 2.5% and Baidu up nearly 7%, Josh.
All right, thank you, Jared. Appreciate it. And in Washington, once again staring down the prospect of a government shutdown with funding set to run out. Lawmakers remain divided over spending and policy riders. Our Washington correspondent, Ben Worschel, is tracking the latest from Capitol Hill and what's at stake. Ben, you know, listen, I think, Ben, at this point, some investors, Ben, they may hear the phrase government shutdown and you can just sort of feel people's eyes kind of glazing over. But explain to me, Ben, why they shouldn't be glazing over, why we should be paying attention here, Ben, and whether this is really going to happen.
For sure. I even live here in Washington, and my eyes can kind of glaze over with this shutdown talk. But there is a growing sense here in Washington that this time could be different. And that's because the political dynamics are shifting here. This is especially true after Donald Trump canceled a meeting with Democrats that was scheduled to take place today, but is now off the books entirely as both of them go forward. It gets to kind of a larger dynamic that is solidifying here in Washington, I think, by the day, that both parties at least have factions within their party that are not only okay with the shutdown, but view it as an opportunity, either a political opportunity or a policy opportunity. So there's lots of energy, and the political pressure seems to be pushing in the direction of a shutdown on both sides. It's not to say the time to watch will be early next week when all the lawmakers return and a wave of final negotiations happen. But the man in the middle here, as usual, is Chuck Schumer, the Senate Minority Leader. He, reminder to folks, he was the guy that kind of blinked in March at the last shutdown standoff and made concessions that averted that. His message this time around is that I'll give you the quote, "The world is totally changed from March." The question is whether folks believe him yet and whether Democrats will be willing to kind of see through a shutdown, which they have historically have not. We're going to get a big sense of that early next week, as I mentioned, when these two kind of negotiations begin in earnest. But right now, folks are talking past each other. And we're going to have this kind of 48-hour period, Monday, Tuesday, when we have this wave of negotiations and either they see it or we start to see a shutdown that could have economic effects, starting scattered at the beginning and that grow over time.
So how might a shutdown, Ben, let's just walk through this. How would it, how would it actually play out? Like if it comes to that, what would be at stake here for markets, for federal workers, for the economy, if the government really were to close its doors?
Yeah, so there's a few stages of this. The first one is images we've seen before. Airlines are usually in focus early in a shutdown because air traffic controllers and TSA agents are government employees. The way this generally works is that both of those groups are asked to continue working without pay, which can cause disruptions and things like that. So airlines are usually in focus, and there's a lot of images we'll see. We're expected to see a closed Lincoln Memorial, closed national parks, things like that. What I'm watching are a couple more after that. The first one is how the Trump administration actually gets into mechanically approaching a shutdown. That's because Trump's team has toyed with the idea of kind of using a shutdown as an opportunity for policy changes. Cabinet members get a lot more power during a shutdown to essentially decide who is essential, who's not essential. There's a lot of leeway they have there that people don't realize. And so they could use that to enact their policy goals. People have likened it to Doge under kind of a different name, sort of using a shutdown powers to do that. So that's one that would be, it's to be determined how far the Trump team would go on that. But if they did, it would be very controversial and could have economic effects and put political pressure. In terms of larger economic effects, the deadline here is a little further out. The rule of thumb with shutdowns is that the only time it's a real drag on the economy is when it's measured in weeks as opposed to days. Basically, in a couple-day shutdown, government funding stops, but then it catches up when the government opens. If we're going into weeks and times, we're going to see a lot of alarm bells. But that, again, that deadline's a little ways off, so that would be kind of a mid-October thing if we're still in a shutdown period after a couple weeks. Then we might see a real drag on the economy. But it's a lot of these kind of smaller issues to start things off.
All right, we'll keep watching. Ben, thank you. Appreciate it.
Sure thing.
Stocks holding near record levels here, but cracks may be forming beneath the surface. Fundstrat's Mark Newton says a pullback could be coming before markets power to new highs in 2026. Let's break down the technicals, the risks and the opportunities that may be opening up. Mark, it is always good to see you. Let's start big picture, Mark. You look at the broad gauge, the SPX, the S&P 500, a bit softer here today. Does it feel like it's getting a bit tired to you here, Mark, in a period of the year where traditionally, weaker?
Hey, Josh. Well, thanks for having me. Look, if you strip out technology, the market actually has been tired since the latter part of July for the last 2 months. We've seen the equal-weighted S&P literally go nowhere in 2 months' time. And so, yes, thanks to technology, indices do appear to be climbing day after day. But there has been this divergence of sort of a bifurcation between tech and the rest of the market. And so that does not necessarily have to be, bearish for the market, but it is important at some point that we see the broader market start to play catch up. That has not happened as of yet, despite the fact that we've seen IWM break out and the move in small caps. So that's really the first thing that I'm looking at. And the second is that, we still are in a very bearish time of seasonality and cycles that do turn down. And a lot of my cycles turn down from mid-October into early November, a little bit later than average. So, I think, the near-term weakness likely could have played out over the last couple of days, yesterday and today. I don't expect a lot more weakness in the near term. I think we do start to turn higher, and that's really across the board in equities, treasuries, crypto. But I do sense that as we get into October, if we can't see some further degree of sectors coming back, then we could set ourselves up for, potential weakness during a time when everybody thinks that it's off to the races. And, sentiment honestly is still somewhat subdued. We're not really at all that speculative levels. And so that's one thing that continues to be, very, very good for the market bulls from a contrarian standpoint, is that people just don't believe in this rally and, concerned about tariffs, concerned about inflation or the path for the Fed's rate cuts. Obviously, the Federal Reserve being under close scrutiny these days. So, it's an interesting market, but yet again, it always is. And happy fall officially.
To you as well, Mark. Happy fall. Let me ask you though, when you look at the SPX, just drill down a little bit there, Mark. What are the levels you're watching specifically?
Well, I think 6,700 is actually a pretty big deal. I mean, my target for the year was 6,650, so that's been exceeded. I don't sense that we can probably move up above 7,000 really into October. That would be a big move. And then I sense we probably have about a 3 to 5% move down. Look, the good news is that, as I mentioned, sentiment remains negative. We have great technical structure and breadth. If anything, small and mid caps coming back is a very good sign. Despite the bifurcation, I mean, technology leading is not a bad thing. We've seen a great comeback in a lot of the data storage stocks, computer data storage, like the Seagates of the world and Western Digital. They've been tremendous, along with a comeback in semiconductors and, of course, Intel. But really, it's been NVIDIA. So the one thing that I looked at this week to say, why could markets stall out? It's because both Apple and NVIDIA are right up to all-time highs, and they really are stalled. So that's 6 to 8% of the S&P, so 15% combined almost. Those hit pretty critical levels. Unless the rest of the market moves up, then we're seeing a little bit of a churning here, but not really all that problematic. And if anything, it's a very different market than 2021, when we did see breadth really start to plummet, and it was only technology. So I'm pretty optimistic over the next 4 months, but I think it's probably going to be a choppy period really between now and November.
You mentioned the semis there, Mark, and Micron did report. So, as investors, we're always looking to read-throughs for the broader semi sector. When you look at the semis, Mark, do you like the technicals there?
Look, it's tough not to like them. What we see, weekly, monthly RSI, right around a 75. So they've gotten very overbought, but the trend has been a nonstop freight train to the upside. Most of the earnings reports that come out, most of the leading technology analysts continue to say the same thing, that AI is a trend you just cannot fight, and it continues to move higher, continues to impress on many different metrics. So, I think this is going to be with us for some time. I think it's very difficult to try to pick tops. If anything, you might get a few days of pullback, but, I want to see some evidence of greater technical deterioration before thinking we're going to get any sort of bigger move to the downside. I think it's right for investors to stay invested between now and year end, even if we get some hiccups. Emerging markets look great to me. I think the dollar and yields both pull down over the next month. Should be continued great for that area, and cryptocurrencies as well as treasuries and equities. So it's tough to find too much fault.
The AI trademark still in focus. Does that mega AI trend and theme, does that still look intact to you, Mark, when you look at the charts?
Yeah, very much so. Look, Josh, we've had a little bit of a shuffling, of course, of the leadership in the last couple of months. It's been very evident. You've seen former laggards like Alphabet really come to life, whereas former leaders like Microsoft have now been lagging of late. So, that's been ongoing all year long. If anything, former laggards like Tesla have now started to reassert themselves and show very good signs of strength. So I'm very encouraged with the group as a whole. I don't see really any issues trend-wise. If anything, it's just more, internal sector dynamics of some bifurcation and some, change in leadership, but it's really not that troubling.
Mark, always great to see you, my friend. Thank you.
Thanks, Josh. Take care.
Coming up, Alibaba plans to ramp up its AI spending past $50 billion. We'll explain what that means for the stock and the future of the company. Plus, is the Fed paying close enough attention to the fragile job market? We're exploring that. And Amazon Zoox wants to rev up the reach of its robo-taxis. We'll explain what's at stake. All those stories and more coming up. Markets are awaiting more Fed speak along with PCE inflation data out later this week. Fed Chair Powell addressed the state of the economy Tuesday, saying higher inflation and lower employment pose a challenging situation for the central bank. My next guest says the focus should be more on the labor market at this point in time. Joining me now is José Torres, Interactive Brokers senior economist. Jose, great to see you. As always, on set. Let's start there with Powell's comments on inflation and employment. It's a challenging situation, he says, Jose. What do you make of how the Fed is navigating that challenging situation? Are they making the right moves, in your opinion?
Great to see you, Josh and Brooke. Look, I think that the statements were way too balanced. When you look at what's going on in the labor market, we got a first month of job losses since the pandemic year of 2020. That was June of this year. That got revised down to negative 13,000. 3-month moving average, we're doing really bad on a historical perspective, only 29,000 per month on job gains. When you look at what drove the 50 basis point cut last year in September, that was 3-month job growth of around 80,000. So we're way below half of that. I think the Fed ought to start cutting more aggressively and start communicating that, because too balanced of a perspective risks an economic downturn at this juncture.
So the jobs market is cooling. Why is it cooling, Jose?
Well, you have a lot of the rate-sensitive, cyclically oriented areas. They don't feel comfortable hiring right now, namely real estate, manufacturing, and small business. Immigration restrictiveness is also a huge deal. You don't have the supply of workers, while at the same time, like Chair Powell mentions, you also don't have that much demand for workers. So it's a confusing situation. But I think that monetary policy is far too restrictive, and that's one of the main reasons why job growth is way down this year.
So they cut by 25. Are you suggesting you would have agreed, Jose, with Dr. Stephen Myron, who wanted that jumbo size cut? Would you want to see 50?
I would have wanted to see 50, honestly.
would have.
I would have, and I thought that some of the dissenters from July would have wanted a 50 this month as well, but they didn't, namely Governors Bowman and Waller, right? They wanted to go 25 in July. My thought process was, well, if you wanted to go 25 then, and labor market has weakened significantly. We got those benchmark payroll revisions. We got the recent numbers. We got claims up to a 47-month high that week that had exceeded 260,000. If you thought 25 in July and you're kind of inching towards 25 in September, why not a 50? So, I would have supported a 50 in that case.
What are the risks, though, of cutting when inflation is still above target?
The risk there, of course, is that price pressures will gain momentum and become more of a threat. But the lesser of the two evils is definitely to focus more on the labor mandate. We remember back in the 2008 great financial crisis, how long it took to recover those jobs. It took to around 2015 to recover the lost jobs from 2008. Inflation, a PCE report out on Friday.
Yeah, what do you expect there, by the way?
Overall, 2.7% year over year. Core, 2.9%.
Not where the Fed wants it, Jose.
Not where the Fed wants it, but the Fed talks a lot about tariff-fueled price pressures. We're not seeing that. We're seeing the cost pressures, folks. We're seeing them in services, discretionary areas, hotel stays, right? Those things don't inflate.
Can I tell what the economists who take the other side, they are on the show. You know what they say, Jose? They say, Jose, don't pop that champagne just yet, my friend. It's coming. The tariff pain's coming. What do you say to that?
Look, so far the inflation has been consumer spending. It's been a big rebound. Let me talk to you a little bit about the consumer, then go right back to tariffs and potential inflation later. Right now, the services numbers and the strength, that's what's driving up inflation from the discretionary categories that don't inflate when you're worried about a downturn. Hotel stays, those things don't inflate when you're worried about a slowdown. Also hotel stays, airfares, as well as dining. Big discretionary categories. As far as tariffs, why I don't think tariffs are going to make a meaningful impact in the medium to long run on inflation, because when you look at what's actually sensitive to tariff, it's only core goods, only makes up roughly 20% of the CPI. Of those core goods, 15% average tariff, it's not enough. The math is not enough for that to really move the needle north on the CPI and on the PCE for that matter. So that's why I don't think that tariffs are going to make a big impact. But when you have reaccelerating growth, right, that does push inflation a little higher. Trump 1.0, we saw the CPI get to 2.93% and then start retreat lower. It's the growth, it's the milder regulations, it's the lighter taxation, the low energy cost, the pro-business environment. That's really keeping services a little offsides in terms of their inventories, and they're not able to really catch up with the demand, which is very strong following a first half where consumers were worried about tariff uncertainty, worried about financial market volatility. They look at their 401ks, back when we were here on Liberation Day, and they see those wild swings, they get nervous. But now the consumer's feeling better. Subdued unemployment, helping the lower and middle income cohorts. And then, of course, the capital markets have been outstanding despite this recent bout of mild selling that looks a lot more like profit taking rather than any kind of panic or worrisome volatility.
So we were talking the job market. I want to get you out of here on this. Big picture, your view, just broadly, of the U.S. economy, Jose. Where are we? Where do you think we're headed?
I think we're re-accelerating here, especially because we're going to get the benefits of fiscal stimulus and monetary stimulus towards year end. We're re-accelerating. We saw new home sales. I think this is the beginning of the recovery in the real estate sector. 43-month high. Yeah. 43-month high. Unbelievable.
It's a volatile number, Jose.
Very.
Yeah.
Very volatile.
Yeah.
But prices increased. Inventories totally took a dive down to roughly 2-year low or so on the month supply ratio. So I'm expecting to see real estate construction start to impact more positively. Manufacturing, great from an investment onshoring perspective, but not good from a hiring perspective or from an ordering perspective. That's going to start to improve when we get easier monetary conditions. And then also small business. Small business cannot handle these kinds of rates that translate to higher small business administration loans that a lot of the small entrepreneurs here in the United States, they depend on for financing. Those areas are going to start to be more buoyant, which is why you saw the Russell 2000. Right, you saw the Russell 2000 break out of that double top formation, looking to make breakout to new upside. They're the most levered to domestic conditions. It makes sense for them. And they're also financially vulnerable from a balance sheet perspective, as well as a lot of the firms in there are losing money, so they benefit disproportionately from monetary policy easing. As far as our customers, they're expressing those views. We're seeing a lot of customers come in, they're buying stocks, they're buying call options. Forecast contracts are a new thing, buying a lot of bullish instruments on economic indicators like GDP, payroll, employment, retail sales, as well as the major benchmarks and a lot of other things.
I love it. Economist also threw a few technicals in there. Thank you, my friend. Appreciate it. Always good to see you.
My pleasure. Great to be here.
Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me for a look. We're going to talk Alibaba, maybe a little Amazon, throw in some Campbell's. We're going to start with Alibaba, Chinese company planning to hike its AI spending. This one, stock was surging. Plans to invest more than $53 billion in AI, Brooke. That is above an original bogey it put out there. CEO saying overall investment will accelerate to some $4 trillion globally over the next few years, and Alibaba intends to be a part of that move. We're up almost 10% here.
Yeah, up almost 10%, jumped as much as that. And really, you say the word AI, and it seems like investors go flocking. That's certainly what we saw play into today's Alibaba share. This is the highest level since October of 2021. It did fall off from an all-time high of about $304. Right now, the stock is sitting around $177. But keep in mind, the optimism that's on the street right now, there are 46 buys and just 3 holds. And so certainly there's lots of momentum moving into this. Of course, Alibaba is often compared to Amazon here in the U.S., this major e-commerce business, this major cloud computing business, and we are hearing some expectations for the cloud revenue as well. We know that the cloud revenue grew 26% year over year during its April to June quarter. Now we're saying that we could see even more growth there. So there is lots of optimism moving into that. Of course, we are seeing just a tiny bit of a sell-off here from major tech players that we've also been hearing around investing in AI, like Google, Alphabet, Microsoft, Meta. But all in all, there are major investments going into AI, something like $360 billion of those Mag 7 leaning into the AI investment here. So Alibaba winning off of that back tail as well.
Alibaba up more than 100% in 2025. Did you miss your shot to get in, Brooke? Did you miss your chance? Analysts don't think so. 94% of them. 94%, even after that move, they say Alibaba's still a buyer.
Yeah, lots of buys, lots of momentum. Also, another Chinese stock seeing a win today, JD.com.
Yeah, there you go. All right, turning now to Amazon. That stock is getting an upgrade over at Wells Fargo. So this one, Wells Fargo says, you know what, we're going to take this one to overweight, so they're fans. See AWS achieving 22% revenue growth in 26. Previously thought it would be more like 19%, it looks like. It's unit share losses. They say peak in 25, see improvement in 26. Target goes to 280.
Yeah, and another factor here is they are seeking out wider clearance for their driverless vehicle business, that's Zoox. So we're seeing, I liked what the guest previous, José Torres, had said, that we're seeing some profit taking rather than selling today, and that's why you see Amazon just roughly flat today. But this excitement around Amazon playing into this driverless vehicle market, they are expecting that they're preparing for this larger deployment of their driverless vehicles, as many as 2,500 vehicles. We saw Tesla do really well when they announced investments in that driverless vehicle operations. Also, Google has Waymo, but also similar to what we just said about Alibaba is really that cloud computing business, or rather AWS. What sort of growth we could see there, and the momentum that we could see on the back end, achieving something like 22% revenue growth in 2026. And so really this strong conviction around that AWS business. It feels like Amazon really does it all these days. So certainly some puts and takes there.
All right, lastly, BNP Paribas warning of a risk coming for the Campbell's company. What is that risk, Brooke? Will they call out losing market share due to chunky price increases in its ready-to-serve soup portfolio? The price increases, they say, they've outpaced those taken by rivals, that has seen volume and dollar sales declines worsen over the past 8 weeks. What do you think?
Yeah, there's been a bit of hesitation on Campbell's right now. Of course, they have that major portfolio. They have everything from Cape Cod chips to soups. It's also soup season. Did you know that?
I did not know that.
Autumn to winter, so happy soup season,
it does feel
Josh.
chilly. Yeah.
So they're really trying to lean into what exactly this can mean. This is their biggest momentum moment. We know that soup season accounts for something like 2/3 of Campbell's sales. And so there's been some hesitation, like I said before. There's only 3 buys, 15 holds, 4 sells on the street. The average price target right now is sitting around $35. Right now it's $33, so not really much momentum there. And really just trying to understand, how does Campbell's play in when they have everything from Cape Cod chips to the soup business?
It's a good chip. It's a really good chip.
I do love Cape Cod chips.
Great chip.
I do love them as well. But there's also some question, with all this under their portfolio, we've seen so much big breakup in food, and not necessarily this analyst from BNP mentioning this, but other sources that I've spoken to on the street saying, could we see a breakup come from Campbell's? Are they next, given that they have so much in their business? They have that recent acquisition of even the sauce business, Rayo's. And so just trying to understand where Campbell's plays and the consumer demand that we see right now in terms of pricing power that this company might have.
Stock is down about 20% this year. Most on the street at a hold on this one. Average target looks to be 35.
Yeah.
Brooke, thank you. Appreciate it. Coming up, more market domination right after the break. Shares of Lithium Americas surging after reports that the Trump administration is seeking an equity stake in the mining company. Senior markets reporter Inez Ferre has a story. Inez.
Yeah, Josh, and this all goes back to a loan from the Department of Energy for $2.26 billion that was granted under the Biden administration to Lithium Americas for a project called the Thacker Pass, and it's in northern Nevada, and it would be the largest lithium producer in the U.S. It's a joint project with General Motors, GM. So Reuters reported last night that the Trump administration wants a 10% stake in Lithium Americas as it renegotiates that loan. This is a similar playbook to what happened with Intel, with the stake that the government took in Intel using some of the CHIPS Act money that was for Intel and negotiating the deal that way. So very similar playbook in that respect. And this stock is up 90%, 95%. The market cap of this company, it's a small caps company. It's a Canadian miner, and its market cap went from $730 million last night to $1.4 billion right now. And the company put out a statement responding to the share price spike, saying that it is in discussions with the Department of Energy and General Motors, its joint venture partner in the Thacker Pass lithium project, regarding the DOE loan. The topics of these discussions include certain conditions, as well as incremental requests from the DOE. Now, why is this important? It's because lithium is a critical mineral that's used, a component that's used in electric vehicle batteries, but not just electric vehicle batteries. It's also used for grid storage. It's also used for Tesla megapacks that store energy. So these are very important components of energy storage, and you kind of have to connect the dots with what the administration has been doing with taking a stake in MP Materials, the rare earth minerals miner, with taking a stake in Intel, went through regards to chips, and now with taking a stake with lithium to sort of wean itself off of the dependency of places like China, where much of the produced lithium comes from.
Thank you, Inez. Appreciate it.
Thank you.
Well, changes to the H-1B visa program set to impact foreign professionals looking to enter the U.S. And Yahoo Finance spoke to top executives at Payoneer and Udemy on what this means for the global labor market.
It's a really fascinating moment because emerging market talent has always been the lifeblood of global innovation, right? Whether coming to the US on an H-1B visa and then starting a business here, or coming to the US, learning skills as part of our education system, and then going back to Bogota or Turkey or to China to build innovative companies. So we think short-term employment in the US, this constricts the supply, which raises the price for the workers that'll be here in the US. Long term, I think this is probably going to drive innovation in emerging markets. And we're seeing lots of energy among our customers to keep the domestic workers, the domestic talent home, and have that invest in their businesses there. So the innovation hubs of the future may not be Silicon Valley or Seattle, they may be in Ho Chi Minh City or Mexico City.
Interesting. Hugo, is that what you're seeing as well? And I should mention your background as well. You were head of the technology practice at McKinsey for a long time, so you have that experience with this as well.
Yeah, listen, it's a very interesting time. We see the labor market shifting. AI is playing an incredibly disruptive. The new generation that's coming out of school is struggling to get jobs, and they're coming to platforms like Udemy to figure out how do I, get the certification that I need. I think in the short term, to your point, I think the folks in the U.S. will use the platform to kind of get the finishing certification and learning that they need. On a global basis, though, I think over the long run, we need to be very careful. We do need the innovation that comes from attracting the best talent for the opportunities we have.
But part of the argument, of course, is that we should be relying more on homegrown talent, right? So does this then provide an opportunity to folks who, like people who are coming to your platform, to try to get that extra layer of education?
Absolutely, and that's what we're seeing. I mean, year over year, so far, just on AI, 5 times more classes. Every minute, 8 to 10 people sign up for AI classes. It's a pretty important thing. They do it on technical stuff, but what's really interesting, they're doing it on the soft skills or the adaptive skills. How to do creative thinking, how to collaborate, how to communicate. So it's a mixture, but yes, people are using this moment to kind of finish and polish their degrees, or when they're trying to do a transition to a new job, to kind of get the degrees and the skills that are being demanded in the market.
John, when we think about this $100,000 fee and also the lottery portion of it, at the same time, I think of headlines of some of the big tech firms who are shelling out these huge signing bonuses, for example, for new talent. $100,000 is chump change for some of them. But where does this H-1B visa talent typically flow to in the U.S.?
Yeah, it unquestionably goes to the big firms. And the big firms can afford, Microsoft, Amazon, others can afford to pay what they want. And the largest firms set the market rate for talent. And so those firms can afford to continue to pay. The scaling businesses, the entrepreneurial businesses, need to go global for talent. Talent is global, capability is global, brilliance is global, and entrepreneurs recognize in the digital economy, you need to find the best person for the job, and that person may not be in your same zip code, they may be halfway around the world, and if they get the skills from Udemy or elsewhere to participate, the soft skills and the hard skills, that's actually really good for global entrepreneurship.
I can't help but think of, as we talk about what you're saying about the effect on innovation here in the US, about also some of the cuts to research funding to universities, for example, which would also seem to stifle innovation to some extent.
Yeah, I mean, if you think about in China, 1.5 million or so engineers are minted every year, and it's single-digit hundreds of thousands in the United States. The U.S. education system, the innovation economy, needs to invest in training people in the skills they need so that they can create the value in the companies of the next decade and the decade after that.
At the same time, I'm struck by this headlines I've seen about this being the toughest job market for new grads in a very long time. And in part because no matter what training they get, AI is doing some of these jobs, right? Whereas requiring fewer people to do the same job. So how do people adapt?
So we have a really interesting economy right now because, as you said, the newer grads are struggling to get moving. And then the kind of organizational structure that are being put in place are also different. You have a lot more, one managers for a lot of folks, and then soon we'll have agents. So you'll be managing a bunch of agents. So there's a very, very different business model that's emerging. And what we do need to do, and a side effect of this policy, is we're going to invest in making sure this new generation is getting the kind of education that they need and to finish and learn how to do specific things that are going to be relevant in an AI world. And I don't think right now our education system was not ready for this. Right. It has happened so fast. So, I mean, we're playing a role to try to close that gap. And we need to find ways. We need to mentor the new generation. And that's one of the biggest challenges that we are not talking a lot about. How do you get mentors out there to give the opportunity to this new generation to be able to do the things that they want to do and build a family and a successful life for themselves?
John, I'm curious how all of this is affecting your hiring between, getting international talent in here and then also, are you hiring as many people because of the changes?
Sure. We've been global since day one. So we're at the first and last mile of global trade. So we have people on the ground in Lahore, Pakistan. We have teams here in New York. And that's the model that's worked really effectively for us. In terms of AI, we are looking for people who bring AI skills into the organization. And to Hugo's earlier point about soft skills, if the labor you bring has to have empathy for their customer, know how to write and communicate, understand how to ask the appropriate questions, all the skills that people used to think were liberal arts degree skills actually are super useful in an AI world of separating someone who can just write code and someone who understands how to communicate and interpret information.
Coming up, it's time for another edition of Goodbye or Goodbye, a segment where experts pitch one stock to consider and one stock to avoid investing in. Stay tuned. Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise to navigate the best moves to your portfolio. I'm here now with Bill Davis, Tennessee Sustainable ETF Manager. Bill, let's start with what you like. And what you like is McDonald's. I was there yesterday, Bill, with the 6-year-old. Nuggets, fries, slushy was delicious, Bill. Here's what's not delicious, though. This stock is only up around 5% this year. You say it's an opportunity, though, Bill. So let's go through the reasons. 1, years of increasing dividends.
Yeah, actually 48 of them in a row. So we think it's a very strong value play. I think this is the time for a stock like McDonald's, this kind of market environment.
How come, Bill? What do you mean by that?
I think that there's all kinds of pressure on family income right now. I think actually there's a research company called Lightspeed. Turns out 44% of adults right now in America that shop fast food restaurants, the adults are buying off of the kids menu. So I'm curious whether you did that when you were with your 6-year-old.
You need one meal, and I always end up eating all of it anyway, Bill. Here's another second one. Here's the second reason you say revenue growth.
Yeah, I think that McDonald's is doing a lot of smart things around repositioning their pricing and their offerings, and is going to lead to revenue growth. In the last quarter, I think the revenue growth was 11%, it was 5%, and led to an 11% increase in EPS. But I think the things that they're going to do ultimately are going to make it harder for the competitors to keep up with them. And that's simply because of their scale. And think about their brand. Their brand is known as a value brand.
Sure.
And so I think it's going to be harder for competitors to match their pricing. And I think that the benefits are going to accrue to them, and it's going to lead to still more growth.
Final reason you say move into McDonald's, strong brand push on value.
Yeah, let me actually back up and just say that This STNC is part of the Hennessy family of funds. And it's basically 3.6 billion of assets spread across 17 funds, all very focused on high conviction portfolios. The difference with STNC is that in addition to looking at fundamentals, we're also looking at other attributes such as their material risk factors around ESG. And they happen to be a strong brand, largely, relative to their scale, free of controversies. They're doing a lot of the right things. They're in the top half of their industry group, and I think that they kind of own the values story, and right now they're putting a lot of marketing dollars into it, and I think they're going to benefit from it.
So Bill, you made a convincing case why McDonald's is a buy. Before viewers, though, rush in, let's talk about the risks, potential erosion to margins.
Yeah, well, if you drive your prices down in hopes that you weaken competitors and basically scoop up the business, and competitors and the economy gets stronger, the job market gets stronger, inflation goes down. If all of those things happen, then it could turn out to be a bad play, because ultimately then you've eroded your margins and basically you haven't grown your revenues as a result. So that's the downside, but I don't really see that. I think that's a very low likelihood in the upcoming cycle.
All right, so you like McDonald's. Let's turn to one you don't like so much. You would avoid Darden Restaurants. Now, this one basically has gone nowhere year to date. Most analysts, Bill, on the street were paid to give an opinion. They like this one. You don't. So let's go through the reasons. One, concerns over revenue, EPS.
Well, Josh, let me start by saying I do like the company. We've owned them frequently in the portfolio. They're a good ESG story. They're a well-run company, and more often than not, we own them. I just don't think, for the same reason that I think McDonald's has a higher likelihood of generating strong revenue growth in the future, our revenue growth forecasts for Darden are sort of the opposite of that. We think they're going to have a harder time keeping up with revenue growth in this environment.
Second reason, you say this is one to avoid for now, challenging environment, you point out.
Yeah, I mean, I think that there's a lot of food cost inflation. I think Darden is going to get hit hard with beef inflation and seafood to a lesser extent. So I think it's more of a, Darden products are the places you go when you're feeling better about things. McDonald's are the places you go when you've got little kids who are hungry, or you're feeling, a little less secure about your financial situation.
Final reason, Bill, you think this one is one to avoid margin pressures?
Yeah, I mean, I think that Darden, by the way, is doing a lot of the same things that McDonald's is doing. It's trying to reposition its menu portfolio and related issues, but I think that that's going to put pressure, for all of the other reasons I mentioned, the food cost inflation, I think it's simply going to put pressure on margin.
So Bill, this is one to avoid. What are sort of the risks to that call, though, upside risks?
Well, I think it's the inversion of McDonald's, right? If the economy ends up being stronger than it appears to be, if the job market gets better, if inflation goes down, and then people start spending discretionary, funds at restaurants like Darden's, then I think their strategy pays off.
All right, so bottom line, you buy McDonald's, you avoid Darden. Bill, great to see you. Thank you for your time, those picks.
Thanks, Josh.
Appreciate it. And thank you all for watching. Goodbye or goodbye.